Cost assignment in manufacturing is a topic that might sound dry at first glance, but let me assure you, it's anything but boring. Picture this. You're in a bustling manufacturing facility, machines whirring, workers focused on their tasks, and products rolling off the assembly line. But behind that energetic scene lies a complex web of costs that determine whether a product is profitable or a financial drain. Understanding how costs are assigned can be the difference between a thriving business and one that struggles to stay afloat. At its core, cost assignment is about allocating expenses across products, services, and departments. Why is this so crucial? Well, it's all about profitability. By accurately assigning costs, companies can figure out which products are making money and which are not. This information is vital for setting prices that not only cover costs, but also contribute to profit margins. Imagine trying to price a new gadget without knowing how much it actually costs to make. You could end up selling it for less than you spent, and that's a quick path to financial disaster. Now, let's break down the types of costs we're dealing with. We have direct costs, like raw materials and labor, that go directly into making a product. Think of the wood used to create a beautiful piece of furniture. You can trace that cost directly to the finished product. Then, we have indirect costs, often referred to as overheads. These are the expenses that aren't directly traceable to a specific product, but are essential for manufacturing. Things like rent, utilities, and salaries of support staff fall into this category. They're necessary for the operation of the business, but they don't tie directly to any single item produced. Now, why is it important to distinguish between these costs? Well, it all comes down to accuracy in financial reporting and decision-making. When managers have a clear understanding of where money is going, they can make informed decisions. For instance, if a company realizes that a certain product line is consuming an excessive amount of overhead, they can investigate and identify inefficiencies. This might lead to changes in processes or even a reevaluation of whether that product line should continue. Let's talk about cause and effect cost allocations. This method assigns costs based on a logical relationship between activities and expenses. For example, if a worker is dedicated to manufacturing a specific product, their wages are directly allocated to that product based on the hours they worked. It's a straightforward relationship. The cause is the product being made, and the effect is the labor cost incurred. Similarly, the cost of raw materials is allocated directly to the product being manufactured. If you're producing a chair, the cost of the wood used is directly tied to that chair. But not all cost assignments are that clear-cut. Enter arbitrary cost allocations. This is where things can get a bit murky. Sometimes costs are distributed based on methods that don't accurately reflect actual resource usage. For instance, if a factory allocates its electricity costs based solely on machine hours without considering how much power each machine actually uses, that's an arbitrary allocation. It could lead to situations where machines that consume less power are charged the same as those that consume more, creating a distorted view of costs. This distortion can have serious implications for financial reporting and decision-making. If costs are inaccurately assigned, it can lead to poor pricing strategies and misinformed decisions about which products to promote or discontinue. Nobody wants to find out that they've been subsidizing a product line that's actually costing them money. Now, let's shift gears and talk about the different needs for cost information. Different stakeholders require varying levels of detail. Internal stakeholders, like managers and employees, need granular cost information to make day-to-day decisions. They need to know exactly where resources are being consumed to identify areas for improvement. On the other hand, external stakeholders, such as investors and regulators, typically require summarized information that adheres to accounting standards. They want to see the big picture, not get bogged down in the nitty-gritty details. The sophistication of cost systems can vary widely. On one end of the spectrum, we have basic cost systems, like a single overhead rate system that applies one rate across the entire organization. This is simple and easy to understand, but it often lacks the detail needed for accurate cost allocation. On the other end, we have advanced cost systems like activity-based costing, ABC, which allocates overhead based on the activities that drive costs. This method provides a more precise understanding of how resources are consumed, leading to better decision-making. Choosing the right cost system isn't just a technical decision, it's a strategic one that can influence a company's financial health. Factors like company size, industry, and the complexity of operations all play a role in determining which system is optimal. Larger organizations with diverse product lines may benefit from sophisticated systems that provide detailed insights, while smaller companies might find that simpler systems suffice. Now, let's talk about departmental overhead rates versus a single blanket overhead rate. Departmental rates assign costs based on the specific overheads incurred by different departments. Each department calculates its own rate, leading to more accurate cost allocations. In contrast, a single blanket rate applies one rate across the organization, which can oversimplify and misrepresent the actual costs incurred by different departments. Why does this matter? Well, using departmental rates can lead to improved cost control and better decision-making. It allows companies to identify which departments are more cost-intensive and take targeted action to improve efficiency. Plus, it prevents cross-subsidization, where products that consume fewer overheads end up subsidizing those that consume more. This can lead to unfair pricing and profitability analysis. Constructing an overhead analysis sheet is a practical step in managing costs effectively. Start by identifying all overhead costs, then categorize them into appropriate groups. Allocate these costs to the relevant cost centers and summarize the total allocated overheads. This process not only helps in tracking costs, but also provides insights into where improvements can be made. When it comes to calculating cost center allocation rates, the process is straightforward. Identify the most appropriate allocation base, gather data, and divide the total overhead cost by the total amount of the allocation base. This gives you a clear understanding of how overhead costs are distributed across products or services. Now, let's touch on the idea of using budgeted overhead rates versus actual overhead rates. Budgeted rates provide predictability and stability, allowing companies to plan and control costs effectively. They create a consistent basis for costing throughout the year, avoiding the fluctuations that can occur with actual rates. This stability is crucial for making informed pricing and investment decisions. Using budgeted rates also facilitates variance analysis, which allows organizations to compare budgeted costs against actual costs. This comparison can highlight areas of efficiency or inefficiency, prompting investigations and corrective actions. It establishes benchmarks that hold departments accountable for their spending, fostering a culture of cost awareness. But what happens when actual overhead costs exceed applied overhead costs? This situation leads to under-recovery, where the company has spent more than it allocated. Conversely, over-recovery occurs when actual costs are less than applied costs. Understanding these variances is essential for aligning actual spending with budgeted forecasts, ensuring that financial statements accurately reflect true costs. And finally, let's not forget that cost assignment isn't just limited to manufacturing. Its principles can be extended to non-manufacturing organizations as well. Service industries, healthcare, banking, and even education can benefit from the same cost assignment methods. For instance, in healthcare, hospitals can allocate costs to different patient care services based on the number of procedures performed. Similarly, banks can use activity-based costing to allocate overhead costs to various products based on transaction processing and customer service interactions. In conclusion, cost assignment in manufacturing is a critical process that influences financial health and strategic decision-making. By understanding how costs are allocated, businesses can optimize operations, improve profitability, and make informed choices that drive success. Whether it's through accurate cause and effect allocations or thoughtful consideration of overhead rates, The insights gained from effective cost assignment are invaluable. So the next time you think about manufacturing, remember that behind every product lies a complex world of costs waiting to be understood and managed.